Okay, by the end of this video, I'm gonna show you how to buy a call. You will become an expert in buying calls successfully to generate income. Options give you the right, but not the obligation, to buy or sell assets at a predetermined price within a specific time. One type of option is a call option. Now, when you buy a call option, you gain the right to buy an asset at a set price within a certain period. Call options can provide you with several advantages. Firstly, they allow you to control a significant amount of an asset with a smaller investment, known as the premium. This leverage can potentially amplify your returns if the asset's price rises significantly. Another thing I really like about call options is that they provide flexibility. You can choose the strike price and the expiration date that best align with your investment goals. The flexibility allows you to tailor your trades to take advantage of market trends no matter how much money you really have. Imagine this. You've done your research and you spot a golden opportunity. The stock of a company you believe in is on the rise and you want a piece of that action. Buying a call option can be your ticket to potentially ride the wave of success. So let me show you how you can buy a call. It is always important that when you buy a call with time. As mentioned, when you will be holding these shares for the amount time that you purchase it with. Every single day, your contract will lose value. This is why it's very important that you get time when buying your option contract. When it comes to buying a call option, it's important to understand the concepts of in the money, out of the money, and at the money options. These terms refer to the relationship between the strike price and the option and the current price of the asset. An in-the-money call option has a strike price below the current market price of the asset. This means the option already has some intrinsic value because it allows you to buy the asset at a lower price than it currently is. In-the-money options tend to be more expensive but offer a higher probability of profit. On the other hand, an out-of-the-money call option has a strike price above the current market price. These options have no intrinsic value and they rely solely on the underlying asset's price, surpassing the strike price before expiration. Out-of-money options are generally cheaper but carry a higher risk of ending worthless. If the asset doesn't move in the desired direction, the contracts lose value fast. At-the-money call options have a strike price that closely matches the current market price of the asset. They have a balanced cost of risk, and their value is determined by both intrinsic and extrinsic factors. For example, intrinsic being the stock price goes up and extrinsic being time. Now, before you go running off and buying contracts, I think there's a couple things that you need to understand. Within each option contract, there's a lot of data and information that you can get from each contract. One of the things that you have to look out for is the volume of the contracts, which refers to the number of contracts being traded within a specific period. High volume generally indicates liquidity. Option contracts with high volume are usually those associated with popular traded assets, but it's going to help you get in the trade and get out of the trade a lot quicker. So make sure the contract you're going to buy has high volume. Now, open interest, on the other hand, represents the total number of outstanding option contracts that have not been closed or exercised. It's important to know the open interest before buying a contract because it provides insights into the level of market activity and potential liquidity. Higher open interest can indicate greater market interest, making it easier to buy or sell contracts at a desired price. From there, you're ready to buy your contract. The only thing I do have to say is that as an option holder, it's crucial to be aware of the impact of time decay. If you plan to hold on to an option for an extended period of time, it's essential to consider whether the expected price movement of the asset is likely to occur within the remaining time. Holding an option for too long without favorable price movements can erode its value. Traders and investors often strategize around time decay by aiming to capture price movements within a specific time frame. In summary, time is a vital component in option trading, and the value of an option can decrease as it approaches its expiration date. That's very important to know. With that being said, when you know how to enter the market, you have to know when to enter the market. To do that, we're going to be using indicators. Specifically, we're going to be using TradingView. This is my favorite charting software that I love to use. You could use it on the go. They have a mobile app as well. I'm going to go ahead and make a live trade and show you how you can use indicators to help you find better placements to buy these option contracts, allowing you to make tons of money on each trade. Now, TradingView is free to the public, but if you are part of the membership, they allow you to use indicators. Now, this specific indicator I'm using tells me when I should buy or sell. It does this by checking the change in volume, then providing buy signals and sell signals. Sell to buy puts, buy to buy calls. Now, be careful in what time frame you look at this chart. I highly suggest, if you are gonna day trade, stay looking at the 5-minute chart for your signals. A lot of times 3-minute charts or 1-minute charts may have a buy signal, but it won't be a significant movement and it could cost you money. So make sure you're looking at the 5-minute chart when looking at a good position to jump in. Perfecting the art of getting in and out of a position, regardless of your loss or profits, is crucial. The better you get at it, the more you can trade with higher contracts, that which will increase the amount of profits that you get per trade. I always preach this on this channel: set a stop loss order so you don't lose your gains. If your play goes wrong, stick to it and be willing to exit the trade and admit defeat so you don't have to lose too much money. The art here is perfecting the ability to spot opportunities, hop onto them, and hop out of them. It's not necessarily about the gains. The gains come after you perfect this art. And one last thing, this right here is called an option chain. An option chain tells you the price of each contract. This is how much you're willing to pay up. This is also called the premium. And then it also tells you the break-even price. The break-even price is what the price needs to be at for you to earn profit. So the objective here is to buy a contract for cheap and resell it for more money. Now, you typically buy contracts cheaper when the stock is significantly low. When the stock is at an all-time low, or if the stock has just recently dropped, the call contracts are going to be cheaper. That's when you buy them. When the stock goes up, those contracts go up in value, and then you profit off of that value. The more contracts you have, the more value that you will get. If you want to learn more about option trading, subscribe to my channel and check out my other videos.